Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lemus. Today's conversation is with Eugene Polevoy of Blue Sea Capital. Max, what was a takeaway you had from our conversation with Eugene?
Well, I think there's a lot to talk about this episode. It was really fun and very interesting for many reasons. I could jump into probably 5 different things to talk about Eugene's interview, but in the essence of time, I'll talk about another topic that I always like talking about, which is Eugene's blog post which dealt with EBITDA adjustments. And you all brought up on the episode, Eugene had blogged about 30 to 40% of EBITDA coming from EBITDA adjustments and a lot of the SIMs that he receives. And I think we've all seen that where a banker or a broker sends a SIM around, and most of the EBITDA is attributable to these EBITDA adjustments, which are sometimes hard to understand. And the purpose of them is to identify expenses that are one-time in nature or non-recurring that can be eliminated from the financial statements and effectively added back to give more EBITDA to the company. So as you can imagine, this is a topic where bankers and brokers could get fairly creative if they're trying to sell a business. And Eugene just points out that he's seen lots of these SIMs where, the EBITDA is heavily based on EBITDA adjustments, and he's sick of that. And in fact, he then goes in, of course, when he's evaluating a business and just sort of cuts a lot of these out to get to the real EBITDA of the business. The part that I found really interesting is he even said that in his experience, some of his QofE providers are a little too aggressive in giving credit for some of these upward EBITDA adjustments, which make the business look more profitable. That is really not my experience as a QofE provider. Obviously, the QofE provider needs to be the advisor on the transaction. They need to be reliable and they need to be independent. And if you have a QofE provider that's being a little too lenient on these EBITDA adjustments, I think you have to look at the incentives of that QofE provider and potentially the arrangement that the sponsor has with that QofE provider. I know there's a big push for sponsors to want to save fees and to manage deal expenses, which is totally understandable. And oftentimes there's a request to sort of postpone the payment of fees for service providers until the deal closes. And I think that's really a tricky situation. I think that there might be a solution, a compromise where some of the fees should be sort of deferred to closing. But, when you have QofE providers deferring an entire fee to closing, you have to look at the incentives now of that QofE provider. And they're basically then incentivized for the deal to close. And that is not what you want from a CPA that's your advisor on a deal. You want them to be independent. And even if the answer is this deal should not close, that needs to be the answer. Or if the deal needs to be retraded, that needs to be the answer. The deal should not be pushed towards closing to help the QofE provider get their fee. Of course, we know sponsors are sometimes incentivized to close deals, but I'm harping on something that he didn't talk a lot about, but it's really important. And I think that sponsors really need to be aware of the relationship with their service providers, and they need to position their service providers to be able to give them the right answer, even if it's not the answer that they want to hear.
And Max, so the idea of paying at close, if the transaction is in fact successful, if the transaction closes, and not paying fees while the work is actually undergoing to the diligence provider, how common is that structure?
I think you hear about it a lot. I think you've got other arrangements where the fee is partially deferred, and I think that's a much safer, better structure. But you do hear a lot about groups deferring an entire fee to closing, and then all of a sudden, the sponsor and the independent advisor are all of a sudden incentivized for the deal to close. Their incentives are very aligned, which is not necessarily a good thing.
And if that deal falls apart, dies, the the due diligence provider is just not paid.
They're not. And in some cases, there's even a concept that gets requested of CPA firms to roll fees, effectively to, like, hey, you could charge me more on the next deal. I can't pay you on this deal. It didn't close, but you can charge me more on the next deal if that one closes. To me, that just pours gasoline on the fire. All of a sudden, you've got a complete lack of independence on the next deal. And that's not what this is all about. That is not the purpose of the QofE. The QofE has got to be independent. This deal's got to stand on its own merits. If it's meant to close, it will close. But the QofE provider should be the one that needs the most convincing about whether or not to approve an EBITDA adjustment that increases EBITDA.
And so at LCS, are sponsors pitching you on that, and you're saying no, thank you?
That's true.
Do you see a lot of people push for it?
That's true. And what we do is more of a hybrid structure. So there's got to be money up front. We've got to be able to cover our costs at a minimum and know that our time is well spent and that we're not under any financial pressure to give. Even if you say you're not under financial pressure or you say you're independent, even just the perception of lacking independence is a problem for independence. So no, we don't defer an entire fee. I mean, obviously that's better for the sponsor from a cash flow standpoint, but it's really not better for anybody in the grand scheme of things.
Just one other detail on this, so I'm clear. You had said that diligence providers can be a little loose on allowing EBITDA adjustments because they're now sort of maybe compromised because they want to see the deal close, and so that will make the seller happy. Their adjustment gets allowed, but the buyer's not going to be happy because that's going to result in them paying for more EBITDA and paying a higher price, right? So, and the buyer is the one hiring the due diligence provider. So, if there were bias in any direction, you'd think that the due diligence provider, would be biased in the direction of supporting the buyer's arguments, which is to not allow adjustments. Buyers don't want to allow adjustments.
Yeah. I mean, I think, unfortunately, what we see a lot of times, this is not always the case, first and foremost. And I also think probably most of the QofE firms are doing a good job and they are being independent. But you do have times where you get pushed by a buyer to just be a little more lenient on EBITDA. And I think then you have to think about, well, what is the exact incentive of the buyer? Is there a closing fee to them? Is there some other incentive of why they need this deal to close? Is it that material for them if EBITDA is off by 10%, but the deal still closes and they get a $500,000 fee? This is all about incentives. Everything is, I think, in life. And, you just kind of have to be aware of that. And sometimes the incentive is that the buyer is going to push the numbers up a little bit, within reason, to get the deal closed. And you have to be really careful with that. And that's where you have to push back as a QofE provider. And listen, sometimes the clients are, upset. And then listen, this is not always the case, by the way. Sometimes you find something, you show the buyer that the deal is the valuation's way off and the EBITDA is way off, and you save them from making a bad deal. And then sometimes they retrade, sometimes the deal breaks. I'd say that's most of the time that's what they're looking for. But the other thing I mentioned, where they're looking for the numbers to be slightly higher, that also happens too.
This is great. Great to get your perspective, Max. Thank you.
That's the path of least resistance, right? Hey, let's just keep the EBITDA at 3.8. Then it's a 4.5x multiple instead of pushing it down to 3.3. Then I need to either go back to all the investors, disclose it, persuade them it's still a good deal, or I need to go back to the seller and restructure or retrade the deal, either of which may compromise the whole deal, which I believe in so much. I've already identified a fantastic operator, an operating partner. We're going to take the EBITDA to 4 million in the first 6 months. So why kind of, shake the tree on this one? It's a gray zone area. Let's just permit it, right? So this is how a sponsor could think, especially when you're very deep in a deal and you feel like there are many other positive factors at play, which they invariably do at that stage of the deal because they've been in sales mode for a long time. So these dynamics are really intricate. And the QofE provider, as SMAX said, the number one person in the whole situation on the buy side who needs to stand up and provide a third-party unbiased view of the EBITDA.
And that's why Max is known as bad cop among the three of us.
Among the three of us, that's right. He's the one who kills the deals, and it's a great asset for us to have that, right? That we can balance off each other. And Max gets excited about many deals too, and sometimes we see things that he doesn't. But in general, we feel good about our due diligence capabilities at Minds Capital because we can lean on each other in that way.
I'll just say about the conversation with Eugene. Agree with you, Max. It was a really fun one. Eugene is dynamic. He's opinionated. He had a great first deal that we hear about. So all the ingredients, selfishly, for a great guest, for a podcast host. So a fun conversation. Probably my favorite part was actually when you, Nicholas, and Eugene get into the HVAC business. You are both sponsors who have owned HVAC businesses, HVAC platforms, and you guys really go back and forth as only experienced people could on the strengths and weaknesses of the category, of the business model, where it is in innings, its history, the history of past roll-ups. To me, it was just for a business that gets so much attention, that we've all heard so much about, HVAC. Apparently, there was still a lot more to learn because you guys went really deep on it, and I found it fascinating.
I thought this guy was incredible. It was so much fun to record this. It was the last thing we did on a Friday, and I think when we got to 6 p.m., we decided to wrap it up, but I think we could have kept going. We'll have to have him back. Eugene is, as you said, opinionated. He's very eloquent. He has substantive opinions, so he brings actual meat to the bone. And so you could really, and as we learned throughout the conversation, you can hear it towards the end. We throw bigger and broader things at him, and he was just able to respond eloquently to everything. And he started as an auto mechanic. I thought that was a very fun detail about him as well. This guy has everything you need to go into politics, which he should consider one day. And I would totally vote for him if I was Canadian.
Great. Well, let's get to the interview. A reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average a commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at the website mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form on our website for accredited investors. Fill that form out to be kept in the loop on future raises. Again, it's at our website, mindscapital.co. And here is the Minds Capital podcast interview with Eugene Polevoy. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. The quality of EBITDA in the lower middle market has decoupled from reality. So says Eugene Polevoy of Toronto-based Blue Sea Capital in a LinkedIn post that went viral, I think it's fair to say, in our world. It was one of 3 LinkedIn posts that got our attention. It's gotten the attention of other media as well. PitchBook's Daily Email quoted you today, coincidentally, Eugene. So I don't know if you have a PR person working for you or you're just a natural, but you're getting a lot of attention for these posts. And we are going to unpack all 3. A bit about your history. Eugene worked at a large Toronto-based PE fund before breaking out to do a residential HVAC roll-up, which he exited in 2024 in a sale to Apex Service Partners. He has since launched an independent sponsor shop with his longtime friend and business partner, and with the support of some key family offices and LPs. Their first deal, which closed last year, 2025, is a commercial generator service business that required an initial capital raise north of $100 million. No small feat for a first-time independent sponsor. Eugene Polevoy, welcome to the Minds Capital podcast.
Thank you for having me, Will. Appreciate it.
To set the table here, Eugene, give us a little bit more on your journey, please, from PE up to sponsor with a big first deal in the bag.
Yeah, sure. Appreciate it. And appreciate the intro. The journey started slightly before PE, which kind of paints what we do today at Blue Sea Capital. I started my career as an automotive mechanic at my dad's mechanic shop before I went to law school and business school. I decided to go to law school ultimately to, I think, appease my mother. I ended up not being a practicing lawyer, not even for a day. I never got barred or articled. And I joined an investment bank here in Toronto called BMO Capital Markets and M&A. And then shortly, I guess 3.5 years later, I joined a firm in Toronto called OnCap. And at OnCap, I think I really sort of developed my investment approach and investment style. 6 years into OnCap, I observed the residential services industry starting to get rolled up. Everything from, HVAC, plumbing, and electrical. And I'm sure you've had a lot of guests that have touched some of these industries. And I wanted to participate in that. At OnCap, it was impossible to participate in it buying an already large established business because the multiples were really, really high. And I think we were very value conscious, probably rightly so on a lot of these. I found a small Michigan-based HVAC business that was only $12 million of revenue. OnCap at the time was a $1.1 billion fund. So there was a big misalignment on the size that I was going to try to pursue something that was way beneath the size of that firm. I think we had expenses on broken deals greater than the equity check required to close this deal. And so what I did is I went out and pursued a capital partner. I found one in another Toronto-based firm. And together we bought 3 branches. And then ultimately sold them all in late 2023. The deal closed in 2024.
Thank you for that, Eugene. Although I think the most interesting part, despite the success, congratulations, is the mechanic to law school bit. So I can't let that slip by. So say more about that. You were happy being a mechanic, but mom's pressure sent you to law school, and then you decided you didn't like the law. That was a pretty interesting background.
The combination of that, and when I worked at the mechanic shop, it was my dad's mechanic shop. I thought, I'm going to turn 18 and I'm going to run it my own way. I'm going to, take over. We had big disagreements on how that should be run. I actually, at that time, also got a dealer's license. So I was also wholesaling cars from that location. And my mom sort of sat me down and she's like, look, do you really want to do this? My parents immigrated to Canada. I live in Toronto, Ontario. And my mom said, your dad's a mechanic as a result of an immigration process that didn't leave many other options. Do you want to have other options? And if you do, this is sort of the fork in the road in your life where you're going to have to choose those options. And so I said, I don't want to be a lawyer. And she said, well, how about you go to law school and then you could choose not to be a lawyer rather than tell me now that you don't want to be a lawyer. And so I did, and I chose not to be a lawyer.
Well, wholesaling cars, that's kind of the quintessential hustle, right?
Yeah. Because you're always trying to find a small spread between what you could get, whether it's from one dealer to another. And I was retailing cars as well, but a lot of it was wholesaling and some of it was exporting. There are times where, the market, because of FX, changes and you could send cars to the US, you could send cars to Eastern Europe. So I was doing a bunch of that. But I'd have good months and bad months like we all do in business. And luckily, I didn't close any doors for myself.
Let's hear about your first big deal as an independent sponsor, Blue Sea Capital, this very large deal. How does that happen for a first timer?
Yeah, look, I think we got lucky on a couple of different fronts. When I went out on my own after we sold the HVAC business, I had the support of a couple of LPs, mostly family offices that I had known at the time that said, look, if you go and find a deal and it has any resemblance to what you just did, we'll support you and put money behind you. So you have some comfort, you have some backing there. I also had a little bit of my own money at this point in my career. And so I said, I'm not sure what size of a business I'm ultimately going to buy. It's not going to be a search fund. So it's not going to be a business where I take an executive seat necessarily. And by that very nature, it's probably going to be something a little bit larger. I, at the time, didn't think it was going to be much larger than, let's say, $20 million. One of I want to call him, my longtime friend, but he's also my business partner now as well, and an investor. Was at the time talking to an owner of a commercial generator business, and had mentioned that to me as I was leaving, and had said that he might want to do a deal. And knowing the size of that company, I didn't get initially involved, just thinking it's a really big business. Couple of months into me searching for sort of a business to buy as my first independent deal, we were looking at 3-5 million of EBITDA, kind of that range. And I had another one of these catch ups with this individual, and he said, "Look, you should fly down and meet this owner, and I think you guys are going to get along, and I think we could get something done." And so that was 17, 18 months before we ultimately closed the deal. So even from that first meeting to getting the deal closed took a long time. But to answer your question, the opportunity came our way because of a relationship I had since 2018 with an individual that has been very instrumental to my career.
Well, I guess then the question is, what did that individual see in you? I mean, you had this relationship, this credibility, but still, I might have that belief in somebody, but I wouldn't necessarily entrust them with such a big deal to right out of the gate. So what would he answer to the question of why he brought that deal to you?
Yeah, that's a good question. I think it comes down to our experience together before this deal. So just to give a little more background, this individual was an investor and on the board of one of our portfolio companies when I was at OnCap still, at a company called AutoSavvy. So he had seen me get that deal done. He invested in it, joined the board. We worked together to upgrade the management team, improve our margins, and that business, OnCap still owns it and is doing really well with it, I think. But that business was off to a really, really good start. Then when I left and I did the HVAC roll up, he actually introduced me to the first seller of the HVAC business that I ended up buying, one of the first of the three that ended up being Frontier Service Partners. And so by this point, I guess we've done sort of 2 deals together, and we've been on 2 boards together.
Yeah.
And I think, again, I can't speak for him because he's not on this call, but I'll tell you, one of my reasons for leaving sort of large cap private equity and doing what I do today is because I don't like the concept of, do a deal, run to the next one, do a deal, run to the next one. I like the concept of really try to understand the business you just invested into, try to be value add, even if you're not part of the management team, try to improve the operator of that business or the management team in ways that they don't necessarily have the time to do day to day when they're working in the business. And so he thought the fit here between what the owner of this business, by the way, I should say, rolled over a very large percentage and it still owns a very large percentage of the business with us. And so I think he thought what I did both at, the company back at OnCap when we were on the board together and with the HVAC roll up, he thought that there was a good fit there. And he was, obviously very right, because once I met the seller and had a conversation with him, I think we had a lot of similarities. One of which is we were both mechanics. He was a diesel engine mechanic. I was an automotive mechanic at some point in my life, but that was, one of the connections I think that we had as well.
Always interesting the little details that sellers glom onto, and if they can find a connection point like that, or something that differentiates you from maybe some of the other private equity folks he was talking to, it can make all the difference. So Eugene, your point about not wanting to jump from deal to deal, is that to say that this is going to be the only or one of a small handful of platforms for the foreseeable future?
Yeah, I would say not the only, but one of a small handful of platforms, and for a couple of reasons. The first is I don't know that it's that easy to find a good deal every 6 months or every year that you really want to invest into. And so by the time I find, this took over a year and a half. By the time we find the next one, and the next one, we'll probably be selling the first one. And we could talk about sort of exit philosophy and everything else probably a little later on, but that's one reason. The other is I don't want to build a massive asset manager or even a large asset manager. I have sort of one active partner and one more passive partner. We each individually invest a very significant amount of money into our own deals. I didn't exactly size my investment into this first one, assuming there's going to be 3 more. So I sized, assuming this is 1 of 2 probably in the near term. And I think, look, I don't think you add that much value if you show up to a board meeting every quarter and then show up to the next one, and that's your interaction with your portfolio company. I think to have meaningful value add, I think you have to be a bit more available, and to be more available means you have to be a little more prudent with how you spend your time.
And what about the point, Eugene, that some independent sponsors, or many, need to hit a certain number of platform businesses, need to hit a certain number of platform acquisitions to have the management fees to really feed themselves, or to support a healthy shop? With just 2 in the portfolio, you feel like you can do that, or your needs are less? Or talk us through how you think about, the income, the income that the firm is generating before you have your exits.
Yeah. So my wife will probably tell you my needs are not less, and hers are certainly not less. So it's a very valid question. This wasn't a model built on sort of management fees. I'm sort of fortunate enough that I had also started separately from my HVAC business another business in 2022 in the med spa space with my wife. That business operates and runs. We sold half of it. We still own half of it. I think through my career, one of the things I left out in the initial intro is I've been pretty active also investing in real estate. And so there's multiple sources of income that allow me to do this with, we draw a very small and I would say nominal fee as our, involvement with this company, with the original terms of our investment, but we don't, it wouldn't be enough on its own to sustain a proper sort of lifestyle in Toronto. Toronto is not a cheap city to be in. And so, I've been fortunate enough to have a very diversified set of incomes to be able to allow myself to do this.
It's easy for a lot of people to team up with their college roommate or someone who thinks alike and is very similar to themselves, and come with the same set of skill sets and experiences and viewpoints. And frankly, you see a lot of that, right? And so people team up, and they will even argue that they're very different, even when they're not. But in your case, you partnered up with someone who's a lot more senior than you, probably older than you. And so can you tell us a little bit more about how this has played out and the dynamics of that, and why you find it valuable to have a more diversified partnership where each of you brings separate skills and experiences?
Yeah, absolutely. It's a good question. So Blue Sea has one other founding partner. His name is Sam Cogan, and then this other sort of more silent partner across Blue Sea, but he's very active with this one portfolio company we're talking about now. He's actually less than a decade older than me. He's definitely done sort of a lot of deals and participated in a lot of private equity deals. So I think he understands the private equity ecosystem very well. I think what I bring to the table with Blue Sea and my partner Sam is the ability to help, especially when we were doing the deal, on the actual diligence and the day-to-day digging into the CRM and the ERP. We're doing a CRM and ERP transition right now. What he brings is a little bit more of the, where's the company going long term? How are we thinking about any future exit? How are we positioning the company with the banking world, the investment banking sort of ecosystem? He's friendly with a lot of other sponsors, and so our approach, I think, to how we want to grow this business is very aligned, because we've had 2 other, instances where we had successful investments together, and dating back to 2018. And so I think, when I think back to our time on the board of directors of the business that I mentioned we first met on, and then, building the HVAC business, I could count on less than one hand the number of times we fundamentally disagreed about something. And so I think there's one of the things that gave me comfort that this is a good first opportunity, and one of the things that I think gave everybody comfort as investors that this team is cohesive is the longevity in the team. Sam Cogan, who's directly in Blue Sea with me on the website, I've known him since I started at OnCap. He was at Onyx, so that's 2015, and then the individual you're talking about, I've known him since 2018, and so I think all of us around the table have a pretty long history of working together.
But you specifically partnered with him because he helped open doors.
Yeah, that's right. That and provide the ability to do a much bigger deal than I think Sam and I would have done individually. I think either way, if we do that, let's say the next one, Blue Sea will do another deal, and it may not match the size of this first one. It might be a little bit smaller, but it's definitely more fun to do something, with somebody that you have that much history with.
Jumping back to your deal in the commercial generator space, so $100 million or so of enterprise value up front. Can you give us a little bit more flavor of what the deal looked like when you bought it and where it is at now and where you're taking it? With such a big deal, are the goalposts different than they would be for a true lower middle market deal?
Yeah, look, I think a lot of people, when they look at the sector starting off, would think of it more as a roll-up or a serial acquirer, right? And so we've gotten some questions from investors and just people that know the deal really well. What are you, what was your add-on pipeline look like? A couple of interesting nuances. So the business, when we closed the deal, was about 155 employees. It's now about 180. The difference all being organic. And so the business continues to grow organically in a fairly short period of time. We closed the deal in June of 2025. And so we've grown, I would say, reasonably well organically in that period of time. I think supporting that organic growth with better systems, better CRM and ERP, which are the first things that we're sort of helping to swap out, we believe is going to add value. More important than anything is the CEO that runs the business. So the CEO is the founder of the business. He's started the business from scratch. He grew it to what it is. He rolled over a very material amount. He's the single largest individual investor in the cap table. And so the fact that he's, has all the institutional knowledge of the business and is incredibly aligned, but has a group like us that is able to think about how do you position this business for a larger exit over the next, 3, 5, 6, 7, 8 years. We don't have a defined timeline, which is really good. It keeps us flexible. And the SPV that we raised is also flexible. There is not a defined timeline in there. I think just allows us to be patient and take one project at a time and not have to do this. When I was doing the HVAC roll-up, I felt like I needed to keep acquiring branches to call it a roll-up and to get a roll-up platform multiple at exit. We don't have the sense that we need to do that, and we'll opportunistically do it, but we certainly don't feel like we need to do it today.
Why did you have that sense with the HVAC platform?
The reality is, in HVAC, the growth you're going to get, there's some branches that I had at Frontier that grew well above GDP levels. But if you sort of think about that industry, overall, it's going to grow at GDP-ish. And so in order to get any sort of impressive growth, you sort of have to acquire that growth. You have to buy what you would hope to be undermanaged branches. You'd have to put in your systems, and you'd have to hope those systems produce in those branches, outsized growth and value creation. Here, we are lucky because we're in an industry that benefits from a highly underinvested electrical grid infrastructure across the US. A lot of activity around generators related to data centers. We don't participate much today in data centers. We're hoping that's going to be a growth avenue for us. But what we do predominantly is a lot of healthcare facilities. And in the Southeast US, there's certainly a lot of population growth there. And as a result, a lot more demand in our direct end market for what we do. And so I think, the company has grown double-digit percentages every year organically for the last number of years. And I think we could sustain that and accelerate that without having to buy growth or buy EBITDA as we grow, if that makes sense.
And the generator thesis overall is based on a weakening grid in the U.S. Sort of. That's the tailwind, that the grid is in bad shape, especially as data centers come online.
The macro theme aligns with what you said. There's also a regulated component to it. So in healthcare facilities, you have to have a backup generator for obvious reasons. If you're performing, life-saving surgery, or if somebody's on life-supporting equipment, you certainly have some backup batteries, but you need to be able to run prime power for a longer period of time if you have a power disruption. And so those types of facilities have to have generators, and they have to have regular maintenance and inspections, no different than, let's say, fire life safety, inspections in commercial buildings. And so what you have is this base of this install base that doesn't have any ability to defer or eliminate this expense within their building. It's not a large percentage of the cost of running a hospital. The generator maintenance in a hospital, you could imagine, is not that significant relative to the overall cost. The cost of failure is incredibly high. Especially again in the southeast, where you have weather events that could cause an immediate need, and so the thesis is really twofold. There's this macro thesis that we liked. There's the micro thesis in the specific industry that we're in that I think is under tapped. Everybody talks about commercial and residential HVAC as a non-discretionary industry that they like, which is why the multiples in that industry have gotten to be quite high. I haven't heard as much. I'm hearing more of it now with companies like GenServe and Total Power, but I haven't heard as much overall private equity activity in the space when we got involved. And I think the industry is incredibly kind of like one of these sleeping beauties, I guess, if you would say it, where if you really study the fundamentals, there's very little not to like. Maybe the one thing that's difficult is labor pool. It's a very difficult labor pool and a difficult one to grow. But other than that, if you could figure out a way to train and retain employees, it's a really attractive, stable business.
And Eugene, the fact that it's been overlooked by private equity suggests that it's still very fragmented, I assume.
It is. Yeah, there's a lot of really small players that you probably can't acquire just because they are really subsized. And that's one of the posts I'm sure you might, get to in this chat that I had. And then there's a lot of sort of what I would call unfocused businesses where they will do residential generators, they'll do commercial generators, but that's not exactly, we bought a basically 100% commercial generator business. It's a very different technician base. It's a very different response time. And it's a very different revenue profile because in your house, nobody's telling you to maintain that generator. You'll maintain it because you probably want it to work. But if times are tough, there is no obligation. No one's coming to check your generator just because you're forced to. Whereas in the types of buildings we're in, it's a much more reliable
compliance. Exactly.
Yeah.
Fascinating. And can you share what the revenue was for your $100 million deal?
Yeah, I can. It's sub 100 million of revenue, but not too far from sub 100. It's like, yeah, that's probably the range I'll leave it at.
And I noticed that both your HVAC platform and the generator platform are both in the US, but you are in Canada. Why is it that you're doing deals in the US, or would you do them in both places?
I would, in an ideal world, do a deal right here at home in Toronto. I think the reality is America is much more entrepreneurial. And what I find in Canada is the market's very bifurcated. There's a lot of very small businesses that I would characterize as lifestyle businesses. I don't think they are institutionally investable. There's a lot of really large businesses. And then if you kind of look at the lower middle market, I think it's a very competitive space just because of the lack of inventory, if you want to call it inventory. And we have a lot of really strong lower middle market private equity firms. Not to say there aren't strong lower middle market private equity firms in the US, there's plenty. But I think per company, the ratio is probably more favorable in the US. And the reality is our Canadian private equity firms all shop in the US. Every firm that I worked at in Toronto has done the majority of its deals in the US as well. Which complicates things. It complicates things from a structuring perspective. It complicates things because we have an investor base that's both US and Canadian. And that gets complicated from a tax perspective because you have to put in blockers and structures that allow you to distribute capital efficiently to Canadian investors that originates in the US. But the opportunity, unfortunately, the opportunity set in Canada is thin. It doesn't mean we don't try. We haven't gone that lucky.
Eugene, you're right here. I mean, you're on our border. So having access to this giant market, the gravitational pull of the market of the US is kind of not really surprising. But what interests me about what you said about the bifurcation is the bifurcation that you mentioned in the Canadian market. And we're always interested in hearing what it's like in non-US markets, what the private equity opportunities are, specifically the independent sponsor opportunities are. So can you just say more about that there's kind of nothing in the middle, really, really small and really big and nothing in the middle? And I know it's just Canada, but I wonder if this is something that non-American listeners should pay attention to, and if it might be the reality, a pattern that you see in a lot of countries of similar size.
Yeah, it might be I think it's more relative to the Canadian sort of culture, right? And again, I'm sitting in Canada, and I don't want to say anything negative about the country I'm sitting in, but I think the American culture is just much more entrepreneurial. And so you'll have an entrepreneur who builds a business and gets it to $1 million of EBITDA in the US, and they want to get to 2, and then they want to get to 3, and they have a bunch of friends that are at 10, so now they want to get it to 10. I think in Canada, culturally, you get to $1 million, you're not that rich. It's all relative. I mean, you're rich, but you're not. But you're not wanting for that much either at the same time. And so I think a lot of people become very satisfied with that. Our market is also incredibly geographically dispersed, right? We have 9 million people. And there's really 4 cities with any critical mass of population. And then everything in between, there's almost no critical mass of population. And so, I did business in Indiana. I did business in Kansas City. I owned a business in Ann Arbor. All what I would call tier 1 American cities, but all with an amazing consumer base. Very cheap housing. Let's say, Ann Arbor as an example. Reasonably cheap housing. Pretty high average incomes, way better ratio income to house relative to most of Canada. And as a result, a big consumer base that's able to consume something outside of paying their mortgage. I think in Canada, the big companies are the telecom companies. The big companies are, the things you can't kind of live without. Not to say there aren't big companies that are operate in discretionary markets. They absolutely do. It takes a lot longer to build something big in Canada. And so I think if you're deploying capital, it's just easier to find those opportunities in the US. And also people are more deal savvy in the US. You approach a US owner of a business somewhere in the Midwest, and they are not that scared to interact with you. I find a lot of people in Canada, if they have a reasonable business, they kind of really want to be private about it. And they're a lot harder to approach without a banker and try to do a proprietary deal with.
Fascinating.
Yeah.
I know you can only speak to Canada, but I do so wonder if what you just described there is a pattern you'd see across other similarly sized countries.
Yeah. And look, for my Canadian friends, it's not a knock on Canada. It's more a compliment to the US. Let's put it that way.
And the question for me would be the competition level, right? I mean, the US is notorious for high competition in the M&A market, and the valuations are higher, but is there not an opportunity therefore in Canada, like we hear from other countries that we've had on here?
The valuations in Canada are definitely slightly lower. Like I haven't heard of an HVAC business in Canada trading for some of the multiples you hear about every day in the US, just as an industry that I'm obviously familiar with. But I think that's true when you exit as well. And so I think if you're trying to think about, lower entry value, you have to think about lower exit value, a shallower pool of buyers, a less aggressive pool of buyers, a pool of buyers that probably won't put as much leverage on it, and so won't be able to pay up as much as well. So I kind of think that lower valuation isn't really it's not material enough where it's like your cash flow is that much better, your yield, that like you're just going to invest and own it. And I think if you're trying to build something with the view to exiting, you have a deeper buyer universe in the US. And so that's what I think keeps a lot of us. Even I know a lot of searchers / independent sponsors that are Canadian based. I met with 2 today actually that are looking almost exclusively in the US, and I would say opportunistically in Canada. It's like if somebody brings me something of size, I'll look at it, but I know I'm going to find it more easily in the US.
At Minds Capital, we invest equity into independent sponsors in the US mostly, and because 20% or so of our audience here are international, we do see some deal flow internationally, and we are thinking about raising a fund to invest and support independent sponsors internationally too. But your opinion on returns, would the returns be comparable in Canada and internationally to the US? Maybe better because the valuations are different, or worse because the growth prospects are lower? What's your take on that?
Yeah, it's a good question. I don't think they're materially worse. Like I know that there are Canadian private equity firms, one of which I mentioned because I worked at it, that's done Canadian deals, that's done very well with Canadian deals, usually smaller equity checks. But from an IRR or an MOC perspective, I think their returns haven't been any worse in Canada than they were in the US. I just think their ability to deploy capital force them, if that's the right word, to go into the US and to stay there for, so much so that the firm that I started my private equity career at was a Canadian dollar fund when I started. And then when they raised their subsequent fund, they raised a US dollar fund because of the FX, buying mostly Canadian businesses US businesses with Canadian dollars gave them either a tailwind or a headwind on FX that they didn't want to have to worry about. And we raised our money for the SPV for this business in US dollars as well.
Eugene, let's turn our attention now to those aforementioned LinkedIn hot takes.
Sure. Yeah.
Let's talk first about the quality, EBITDA quality, the decoupling of valuation from quality. Tell us the take, and then we'll get into it.
Sure. I'll give some background, I guess, for the readers that may have not seen the post as well. I am not an avid poster on LinkedIn. At least I wasn't until these 3 posts. And I haven't really been that much since either. I've been pretty silent for a while. The impetus for me posting was I think it was either 2 or 3 calls, one after the other in a single day with brokers and sellers on the phone, sort of, earlier intro calls post-SIM. Where I just got frustrated with both the brokers and the sellers trying to justify EBITDA adjustments to me that are unjustifiable. I'll go through some of the examples, but I was sitting on the couch in my house at like 10 p.m. on my phone, ready to go upstairs, go to sleep. And I typed out this, I thought it was a rant. And I posted on LinkedIn. I went to sleep and I woke up and I had like 60,000 impressions on this rant overnight, which picked up to over 130,000 and a bunch of, inbound DMs. And the basis of the rant was, I'm sort of sick and tired of brokers and sellers sending me SIMs with, EBITDA where 30% of the EBITDA or 40% of the EBITDA is an adjustment. And when you dig through the adjustments, it's, we had severance costs this year, so we're going to add that back. And I don't know, I've been involved in a lot of businesses. There's severance cost almost every year. You're always going to be hiring and firing somebody. We have a CRM and an ERP transition that's going to help us be 10% more efficient on our SG&A. So we're going to run rate that efficiency. But by the way, that CRM and ERP is going to be implemented in a half a year from now. It hasn't been implemented. It's like, okay. We do a holiday party every year. It costs us $500,000 to fly everybody into, all our sales team to an event. We don't have to do that. That's discretionary. And, I would argue that is not discretionary if you've been doing it for a long time and your salespeople sort of expect this year-end, perk. And so it's stuff like that. And in the particular example that I was sort of ranting about, that seller also had negative declining sales for the last 6 months of the data that he had presented me. And I'm like, okay, well, let's not argue about whether I agree with these adjustments. Let's talk about your negative sales. Let's run rate that for the rest of the year. Because that I think we could run rate because, I'm not sure what's going to cause that to turn around. And so the reality is when I talk to my friends that work at, private equity firms and pension funds and just across the ecosystem of private equity, everybody admits that these are kind of ridiculous. And it's really just a question of what will the QofE provider sign off on? What will the lenders lend off of? And what will we sell the business off of in the future in terms of what adjustments are we going to have? But none of these adjustments during your hold period produce any cash. And there are some adjustments that are legitimate. Owner owned a personal car that's no longer going to be in the fleet. I mean, yeah, that's very acceptable. I'm talking about the ones that are, much more questionable. And so I posted this and I was a little surprised at how popular, I guess I would say, this post became.
Eugene, wouldn't it, Eugene, can you take it on face value, the adjusted EBITDA that you will see and hear from a QofE provider?
No, absolutely not. I mean, even your own QofE provider, I think they're so used to trying to find adjustments, and most adjustments are positive, not negative, that even with our own QofE providers, and they're great and we love them, we take their opinion, but we have our own number that we underwrite. And I could tell you that the number that we underwrite is often lower and more conservative, obviously lower than what the banker had presented, but also lower than what even our own QofE provider had given us. And I just think people are very quick to take the positive adjustment, but not very quick to account for any negative adjustments.
Why do you see more addbacks and adjustments in the lower middle market versus the larger deals that you worked on in your career, do you think?
I don't know if the larger ones have less Addbacks, actually. I think, look, when I was looking at larger deals earlier in my career, I think private equity was a little more honest about it. I think COVID opened the Pandora's box of adjustments because people's business flatlined, so they had to invent EBITDA for a period of time to stay on side with covenants. I think since COVID, I don't think anybody accepts a COVID add back in 2026, but I think the magnitude of adjustments within EBITDA as a percentage of EBITDA has just, once you pushed it so far, it's kind of like people just accept it. And I don't think it was acceptable in 2015 and 2016 and 2017, a decade ago. So that's one element of it. I think there was a bid-ask spread between buyers and sellers. And one way to bridge it is to swallow some adjustments where you're convincing yourself you have a lower entry multiple than you really do. And the seller is kind of, it hits the value mark for them. And I think, I really actually think, and this is actually a very relevant topic right now with what's happening with all the noise around private credit, but I think lending standards and the definition of EBITDA in a credit agreement has gotten very long and I'll say very creative.
Isn't it true that add-backs and adjustments for large cap deals, they affect the valuation, but for lower middle market deals, they affect the whole viability of the deal?
I think that's right. And the financeability of the deal in many cases. But also there's a lot less real cash flow often in lower middle market deals that have a lot of adjustments that also give you less real runway when you acquire that business to actually run it. And so I think you have to be really careful about that. I think if you're buying a business that doesn't have real cash flow and you're focused on an adjusted EBITDA number, I think you're starting with with a disadvantage.
What are the downstream consequences of being too lenient on adjustments?
Well, lack of cash flow to actually operate the business, to grow the business, to reinvest into the business, to service your debt, to produce any sort of distributions if you plan to produce them. I obviously appreciate that a lot of private equity deals don't plan for distributions during the whole period, but it's a nice feature if you can get it, and I could tell you it helps with your IRR if you could distribute some cash along the way in terms of your IRR hurdles for investors. But the first thing we look at when we look at a deal here at Blue Sea, I don't ask for your EBITDA number. I ask for your cash flow statement because I just find people don't finagle that one as much as they finagle the P&L.
So when you see a report like the one from Axial, where they showcase that the lower middle market entry multiples have remained very stable over time, I think they talk about 5-6x, and that there's discipline around the valuations. You're arguing that that's only true because there are more adjustments in there now. So the actual valuations are probably higher.
I bet they would be, right. So that article that I think, Will, you mentioned at the top of this interview that I happened to be quoted in this morning gave a stat that the average adjustment makes up 30% of the EBITDA these days. And that's up from something much less than 30 a decade ago. And that goes to the point you're making, Nick, which is valuations in the eye of the beholder, a multiple of what, right? And so if you're going to put more adjustments into EBITDA, you could hold your multiple flat and think that you haven't really had, inflation creep on multiples, but you've had inflation creep on EBITDA in terms of what you're underwriting. And if you actually looked at these deals on a cash yield basis, I guarantee you they yield way less cash in 2026 than they did a decade ago.
You mentioned private credit as one area where things are more creative now. What do you mean by that? And what's going to happen to them?
Yeah, look, I think when there was less participants in private credit, no different than private equity, I think the participants could be pickier with what they underwrite. And therefore, they don't need to be as lenient with Addbacks. I think they could go after better credits. I think they could, ask for tighter covenants because there was more, let's say, demand for the credit than there was capital to provide the credit. I think as private credit became incredibly commonplace, and in the case of some direct lenders, they started sort of selling private credit investment opportunities to retail investors, the amount of dollars in that space has gone up. And I think as a result, the discipline in that space has come down. Now, I'm not saying that we have, private credit, 2008 kind of event coming here, like a few people I think have predicted. I do think that there is a mismatch in what investors kind of thought they were investing into versus what they are. And I don't think the security is as good as they might have thought it's been, but we haven't seen, other than Blue Owl having a bit of a moment now with redemptions, we haven't seen a massive issue come up. But I could tell you as a borrower, and I've been a borrower since 2015, negotiating credit agreements with lenders are willing to be more creative, which helps the equity side pencil out. But really what it's done is it's allowed the equity side to stretch as well. Not to mention the equity side has seen the same trend we just talked about in private credit, where there's way more private equity capital than there was a decade ago. So both markets, I think, are growing.
What do you mean it's allowed the equity side to stretch as well? If the lenders are more creative, wouldn't that mean that you need less equity?
Well, less equity, or I could pay a higher valuation and still try to get the deal to pencil out, right? And I think the default, unfortunately, is the market's pushed itself to pay a higher valuation. It was most pronounced, I think, when interest rates were very low, because interest was minimal no matter how levered you were, because the rate is very low, and so you could stretch. I think a lot of those deals, obviously, one of the reasons we're not seeing that much exits today is I think a lot of those deals don't have real viability to be sold. But even if you're underwriting a deal today, I wouldn't say interest rates are that high. And you could pencil out a deal with a lot of leverage on adjustments, because the cash drag of maintaining your debt on side is not that great, depending how far you go. All that to say is, I think capital has entered both private credit and private equity, and it's pushed both to be more aggressive and maybe more efficient is the way to put it, but it's harder to find outsized returns.
So you've spotlighted a problem with adjustments on EBITDA. How do we fix this? How do we get to a world where this is no longer a problem?
I think some of it's going to fix itself over time. There was an interesting article, I forget with which journal it got printed, that there's a lot of zombie funds, zombie private equity funds running around. And so this affects, obviously, it doesn't affect independent sponsors. We're talking about, funds that have raised capital and may not be able to raise more capital going forward. I think as you see some lower middle market funds disappear or not being able to raise their next fund, which means they're not doing more deals, I think discipline's going to come back into that market. I think on the private credit side, it'll be interesting to see what happens with sort of all the noise that's happening around it right now. But like any other market, you get a bubble and you get a pullback, and then you get some rationality come back into it. I think, look, I love private equity, and I think it's an opportunity to buy business and be entrepreneurial with it. A lot of people don't treat it that way. A lot of people look at private equity as an ability to raise money, put it to work, charge a fee, have some upside through carry, which, you'll make a lot on your fees, even if the carry doesn't come through. And that's caused people to worry about capital deployment versus quality of the deal, which is, going back full circle, why we do what we do as an independent sponsors. We don't want to have the pressure to deploy capital. We want to be able to actually invest in companies we're really excited about.
Do you think independent sponsors are penalized less than funds? Meaning raising a second fund is hard, and you definitely need to show the track record. Versus an independent sponsor, there's a lot more of the pitch is deal specific. And so any other track record can be more camouflaged or is frankly less relevant maybe. How are those dynamics, and can that explain some of the growth in the independent sponsor world?
Look, I think it's a superior model of doing deals for a couple of reasons. There's been a lot of really strong talent that was developed in some of these firms, some of which are now going to be zombie firms. Some of them are very successful, but it doesn't matter. Guys and girls at sort of mid-career look at their prospects of staying in a fund and seeing their, carry potentially take longer and longer to materialize. And they say, why don't I go out, buy a business? I control when I exit. I have more economics, maybe with less dollars, but more economics. And so I think it's created a lot of high quality independent sponsors and even some searchers that came out of that type of universe. I think there's an advantage for investors because they get to pick the deal at the time of the deal, knowing the valuation, knowing the industry, knowing so much more than you would know if you committed to a blind pool of capital. I do think the sponsors' track record is relevant because you still want to make sure they have good decision-making capabilities. They know how to exit. They know how to position the company to exit. They know how to create value in the type of revenue that is going to, increase valuation and get private equity firms excited. I think, and I'm biased, but I think the best independent sponsor model is where you've been at one or two, or you and a partner have been at more than one larger fund, where you sat around investment committees, where you understand what larger funds want to buy, why they want to buy it. And then you're able to go out and curate that business. You could go and find it in a market that's maybe less efficient, where it's relationship driven, like what our deal was very relationship driven. You could work with that company and you could almost write the sim for the exit as you own it. Because you know what an investment committee that's going to sit around the table and look at, where they're going to focus. They're going to focus on your backlog. They're going to focus on your, contracted revenue. They're going to focus on your customer attrition, your employee attrition. And so I think as an investor, if you pick the right sponsor and you get to pick the right deal at the time that sponsor does it, I think you mitigate your risk of investing with a fund that's on their fourth or fifth fund, where they're just in the game of, accumulating assets and growing their team.
Nicholas just wrote down your line of writing the sim as you own it.
That's exactly what I was doing. That's a fantastic line. I need to remember that for the article that goes out with the episode. It's a great line for sure.
Great.
Yeah, no, I thought so too. And then I saw Nicholas look down at his pad. So, Eugene, let's talk about another aspect of private equity that you kind of raised your eyebrow at, which is the lack of originality in your LinkedIn post. Now we're moving to the second LinkedIn post. You were talking about HVAC in particular, and how much of this is sort of herd mentality. If you would, please distill that post for us.
Yeah, I'll give your listeners a little background on that. So I was a beneficiary of this. HVAC was what I would call, and still is, in some ways, a momentum situation, right? If you look back at the history of residential HVAC roll-ups in North America, there was a wave of roll-ups before the current wave that did not end well. And for anybody curious, they could sort of research a company called BlueDot, and I'm sure Claude or ChatGPT will give you some interesting, timelines of what happened and how that was a fabulous blow-up. Then there was nothing. I remember in 2015 when I started in my first private equity job, if we ever got a business that was a trades business, a lawn care business, a plumbing business, an HVAC business, we always said, too difficult to manage. Nobody's done well in these spaces before, because that kind of recency bias existed at the time. And we passed on it. And you could have bought these businesses for 5 times and 6 times all day long, sizable businesses. I'm not talking about a small branch. And then there were a couple of successes. Rant started. The big success at the time was a company called Heartland, which got sold by Cowen at the time for like 16 times. And so people were like perking up, like, oh wait, HVAC businesses that I could have bought for like 7, 8 times are now trading at 16. What's going on here? And I know our investment committee and a lot of other investment committees of lower middle market firms took notice. And then they started putting money into that industry. And that's true across fire life safety. It's true across a whole bunch of sort of what I would call blue collar or service-based businesses. Now, it doesn't mean they're bad businesses, but they started trading at double-digit multiples, high double-digit multiples as a platform. There was still an opportunity though. You could go and do what I did. You could go and buy 3 smaller businesses, put a management structure in place, have a platform name, I called mine Frontier, put in some systems that these individual branches didn't have. And then the last piece was most important, prove out that you could grow them post-acquisition. So we had case studies when we were going to market. Every branch showed positive growth, organic in-branch growth, post-acquisition. We had a playbook. We had the makings of, as I just said, the sim as we were building that business. And you could go and sell that business for a big double-digit multiple. I won't disclose the exact multiple I sold for, but it was a double-digit multiple. And there's a lot of ARB there. So not only did we get, EBITDA growth, we also got incredible amount of ARB between what we bought the branches at and where we ended up selling. That's all good. The question is, for me, everybody's jumping into. There was a graphic that I posted on that same post that showed how many HVAC platforms there are. And the sheer number of logos is overwhelming. And where does it go? Who eventually owns these businesses? And how do you manage a platform with 400 brands? right? Each of which have their own Google business account, each of which have their own Google Ads account, each of which have their own set of reviews. And you don't want to change the brands, because when you buy a local HVAC business in a market, like let's say I'm going to use Kansas City, I bought a 90, 80-year-old brand. I don't want to rip out that name because everybody knows those trucks. And so you can't really unify these businesses. You could standardize certain things that customers don't see, but you can't standardize the brands. And so, my question by posting this was to say, who's going to sort of own them at the end? Because I could build something from 5 million of EBITDA to 20, and I could find a home for that. And somebody could take 20 and build it to 40 and find a home for that. But we're having some of these platforms now hit 300, 400, 500 million of EBITDA. And I think the most recent interesting transaction is Blackstone bought Champions Group from Odyssey for, it's publicly disclosed, it was 18 times. How much bigger could it get? It's a residential HVAC roll-up. There aren't that many things left to roll up. They've mostly been rolled up. And so I just think some of these, if you're a smaller player in the private capital ecosystem, you could be smart about it. You could enter a space like HVAC early. Today, I would say that's a later kind of thesis. You could find some really strong local brands. You could buy them. You could consolidate them. And you have a mass universe of buyers out there, from strategics that already got backed by larger funds to funds that want to enter the space. And I think there's a hot moment happening right now, actually, in the garage door space as well. And there's a bunch of platforms in the US that are being formed and successfully exited. So I don't think it's a bad thing. I just think you have to be aware of these trends, and you want to probably be on the beginning end of it rather than the end at tail of it.
Is it a pyramid scheme that as long as you get in at the right time and someone is willing to pay more down the road than you paid, you'll be okay, but you need to enter and exit? It's about timing?
Yeah, I don't like that word, but I can't disagree with your word either. Because yeah, you're right. I think ultimately, I'm not sure that there is a justifiable 18 or 20 times valuation for these businesses at the end. Because what's the exit? Take them public? Some have tried to take some of these larger businesses public. One of the largest Canadian dental clinics was taken public, called Dental Corp. It was then taken private by GTCR earlier this year, because as a public company, it was trading at a lower value than a single dental clinic was trading. It was not trading at a platform value like private equity would value it. And so it got bought back by private equity. Mr. Car Wash, a lot of car wash consolidations happening in the US. Mr. Car Wash just got announced that Leonard Green's going to take it private. These have proven to be really bad public stories, because I think the public investor base doesn't care for run rate adjustments and pro forma, and doesn't necessarily value an M&A thesis. They value organic growth. Google grows organically double-digit percentages every year, right? Why invest in an HVAC roll-up that grows with GDP organically when you could invest in much higher growth stories that are less people dependent and that have, a easier, more exciting story to sell to a public shareholder base? So I just think, I'm not sure who the end owner is of some of these.
But that is the end game, right? A public company. And the S&P 500, and what is it now, 29x right now? And so if you get into that, that's kind of the average betting for companies that are of that size. And so if you're selling to Blackstone for 18.5x, that transaction was just announced here a few weeks ago, then one day you'll be combined with the Apex out of Tampa, and together you might be big enough to go public, right? So I can see, we can all see that that's where it's headed. You're arguing that that's not a good place to be headed based on the examples you provided, but isn't it also true that this industry has matured, not just from a consolidation perspective, but also from a capability perspective? There is a lot more scale today in the marketing, in the branding, in the procurement, in the fleet. They're much more professionalized. The introduction of ServiceTitan has made operations more streamlined and a lot more sophisticated and data heavy. The M&A playbook has been largely perfected, and integration has been simplified because of the technology and ServiceTitan in particular. And so isn't it plausible that these big shops that this industry will in fact move towards a winner takes all for each and every metro out there?
So I agree with most of what you said, but I disagree with the conclusion. So I agree that ServiceTitan has made it much easier to manage a larger portfolio of residential service brands. I also agree that ServiceTitan has given you efficiencies and the ability to track your marketing spend and extract better returns on that marketing spend than than you had, before software like ServiceTitan. I also agree there's a lot of talent in the space now. I mean, it's been an industry consolidating for a long time. It's produced a lot of very capable executives. The problem is when you're big in that space, M&A doesn't move the needle. Your average target is 10 million of revenue. If you, I won't name the companies by name, but some of the biggest ones are 2 billion and 2.5 and 3 billion of revenue. 10 million of revenue doesn't move the needle. And so when you go public, I believe public investors don't get excited by GDP type growth. And when you're that size, you're just going to grow at, US GDP growth rates at best, maybe a little bit better if you're taking some share. I also think when you get really big, you're always open to a competitor that has one truck, doesn't have a call center, doesn't have, the cost structure you have. They may not have the buying power you have on the equipment either, by the way. That's true. But they don't have a lot of the costs and they don't need 50% gross margin. They could operate on 30% gross margin, right? And they will compete with you. And that always keeps... I remember when we sold the business, we had HSR clearance, Hart-Scott-Rodino clearance in the US. For your listeners, it's basically a competition bureau clearance. And, I was holding my breath that they don't stop this transaction because it was a strategic that bought us. And the argument, I had all my arguments prepared, being the good little law school student I was, I had all my arguments prepared if in case we get challenged, why this deal needs to be approved. And one of them is, I don't care how big we are in any one city on a combined basis with our buyer, our competition is still the one guy in a truck who could underprice us at any moment in time. This isn't like a local utility or a cell phone company. There is no monopoly. And so again, I'm very rooted in the belief that these are not good public company stories. And I think if we see the first one go public, I think we'll quickly see it go private soon thereafter, because I think they're going to be disappointed with their share price.
Is that what happened with BlueDot, essentially?
BlueDot effectively disassembled. What happened, I think, in that wave of consolidation is we were smart, I think, in this wave to have a lot of rollover equity. So all my sellers rolled over some capital, and my sellers were very invested in seeing the success of Frontier. And Frontier, I think, was successful because we were very light touch. Every branch manager did what they did. We added 3 things. We added better purchasing power with our OEM suppliers, so Lennox, Daikin, Carrier. We added better marketing techniques and capabilities. So we knew more about Google ads than any individual branch did. And we added a little bit of sophistication around pricing and trying to make sure we're pricing appropriately for the level of service we're providing. And so that added all the EBITDA that I just talked about. It gave us the growth that it gave us. Like I bought 7 million of EBITDA. We exited with 12.5. All that was organic. Between 7 and 12.5 was organic. And there's a limit to, by the way, those levers that we pulled. How much more would those levers have given us? But I guess what I'm trying to say is, at scale, these benefits are already extracted. Like my buyer, Apex, is much better than me at running these businesses. And so once they go public, there isn't like more growth. There isn't a new innovation. There isn't anything that's going to keep the shareholder base that excited. Oh, and back to your question on BlueDot. BlueDot didn't do this. BlueDot didn't have these rollovers. A lot of these guys left. They didn't have the technology, to your point, Nicholas, before, of ServiceTitan to manage this at scale, and it fell apart. What BlueDot ended up doing, I believe, and again, you can Google it because there's a lot of articles written on this, most of these consolidators at the last wave ended up selling their businesses back to their old owners to try to recoup some money, and kind of disassembled. I don't remember if BlueDot went public, but again, that's easy to check and verify. But I could tell you there's been a lot of these. Service Experts was one, I believe, that also disassembled pretty quickly. And one of the branches I bought in Indiana was from a family that owned their branch, sold it to one of the consolidators at the last wave, bought it back. The kids were running it, and then I bought it from them and had a rollover, and we had a successful outcome. But they got to they got to own that business twice.
They were hoping you were another BlueDot. We'll do this all over again.
Maybe, probably not. They did well with us because they did have a rollover, and we had a really good outcome. And I'm actually really good friends with that family still, and they're investors in my current deal. But yeah, I think they were more pleased with this wave of consolidation. It's definitely a better wave. There's more science in this wave, I'd say, and more skill. But I still don't think it justifies the multiples that they trade at. That's why I was a seller.
Well, so Eugene, this is a fascinating conversation. But just so I can distill what you're saying, the one thing you're saying, I think everybody in private equity would agree with and sort of knows, better to get in to a consolidation, a wave of consolidation, a market where that's experiencing consolidation earlier rather than later. You can buy cheaper, multiples are lower, et cetera. There will be more buyers later, et cetera. That one's pretty obvious. The second kind of piece of what you're arguing is that when the consolidation really matures and there are now very large roll-ups with lots of revenue and EBITDA, and their only exit looks like going public, that's when the music starts to stop. There's going to be somebody holding the bag, and that's going to reverberate back down market. So if you're still holding, and maybe you're holding a smaller business, a $5 million EBITDA business or a $15 million EBITDA business, you too will end up holding that business because the buyers will go away because the very, very large buyers have lost their ability to exit.
Yeah, look, I think exactly what you're saying is right, Will. I think the multiples will shrink. It doesn't mean these businesses won't transact. There's capital committed to them. There are platforms. They're still going to want to try to do deals. If you have a scaled business, you might still find a buyer universe out there. The reason why we sold when we did at the time, I believed, and I think it's largely with a few exceptions proven true, that multiples were not going to get higher. They might get lower, but they're not going to get higher. And so, how many years of growth does it take if you're smaller trying to sell into a larger platform to make up for multiple contraction to still get the same type of dollars out, right? And I think the obvious resounding answer for us when we ran the math was we have more downside risk right now than upside. We also had really good TTM numbers, trailing 12-month numbers, meaning our growth in the year that we sold, organic growth was 30%. We were growing far and away greater than GDP or our local market was. We were taking share, but we were taking share using tools we put in place that allowed us to take share the year we put them in place. I'm not sure that those would comp continuously 30% up every year after that, right? I think there's a sort of a bit of a one-time benefit. Yeah. So I find it's a lot easier to sell a business when you're, trailing 12-month numbers are up 30% organically than when they're flat or, down.
So a question for both of you. So I don't know if you know Eugene, but Nicholas was also in an HVAC platform that he himself exited just recently in the last few months.
That's why you knew so much about ServiceTitan there. I was wondering, they had such a good question. I didn't well educated.
No, and interestingly, we exited to Odyssey Group just frankly a few weeks before they exited themselves to Blackstone. And so that was super interesting here a couple of weeks ago when we learned that that must have been in the works for them. The conversation with Blackstone.
Right? You know what they were probably doing is they knew their multiple was 18.5 times.
Yeah, for sure. No, it was well played by them, and it was a win-win. We were happy, and I know now that they were happy. They got a very nice arbitrage on it, so good for them.
Yeah.
Eugene, you said before you kind of took us through the HVAC, your HVAC journey, how in the mid-teens, people, to the extent they still remember BlueDot and that bad outcome, and then private equity in general looked at kind of local home service businesses and said operationally intensive, basically unattractive. And then there were a couple big successes. I think you said Wrench and others, and then that drew in everybody's interest back. Mm-hmm. But going back to just the fundamental nature of these businesses, the fundamentals of these businesses. Mm-hmm. Do you think that they are appealing businesses? Forget the multiples, forget the consolidation wave at their core.
Yeah, look, I have a very soft spot for those businesses because I do think they're great, simple businesses ultimately to operate on the residential service side specifically. The model is simple. If you're good at digital marketing and you're good at making the phone ring and your call center is busy, your technicians will be busy. If you have good technicians that you could keep busy, you're going to retain them. And I think, look, you're operating in a sector where whether you're talking about plumbing, electrical, or HVAC, they're non-discretionary items. As long as you're focused on we were focused on non-new construction predominantly, and we were focused on the plumbing side. We were not focused on renovation, so we didn't put in new bathrooms. We did jobs, smaller jobs that were unavoidable for a homeowner as they own their house. I think they're great businesses. I don't know that I'm capable of running one that's, $200 $100 million of EBITDA. I think that's a very different skill set. But I think at the size that that we were at, we were about 110 million of revenue when we exited. It was a very fun business to run. We put money into Google. Google gave us leads. Leads got converted, and you could measure it all and adjust accordingly. And so I do think they're great businesses.
Mm-hmm.
I agree with a lot of what you said, but not your conclusion. Having been in this business myself, I actually liked it more on the front end than the back end. And I would say competition is the main reason. These are largely undifferentiated businesses. Mm-hmm. When you're a consumer and you Google HVAC repair, you do not know the quality of one versus the other. There are social proofs out there based on marketing and Google reviews. But when I asked a business owner for all the add-ons we did, what makes you different? They would always say, oh, we deliver really good value and we provide super good service and we're high quality. And usually they would couple it with, and we're cheaper than the biggest guys. But a consumer doesn't know that. And unlike a B2B customer where you develop a relationship and it's repetitive, there is no kind of second chance to learn that. A consumer will not do 3 replacements and then figure out which one is the best for the long term. And so, yes, it's extremely marketing driven. It's also a seasonal business. Mm-hmm. It's very weather driven. So this was always outside of our hands. And we're in a business with Minds Capital that is also seasonal, but it's based on Christmas and Christmas holidays. And so this is a very predictable season. You can know exactly how many days there are going to be in 2029 today. Yeah. But I cannot know exactly, sitting here in March, how many days of very hot summer Texas will have this year. Will it start in April, like it sometimes does with 100 degrees? Or will that come in late June? Will it last to Labor Day or to Halloween? These are, and you don't know, and you have to pre-plan your procurement, your fleet, your marketing, your labor more than anything. And labor, by the way, there's just never equilibrium. It's a workforce, and there's always something going on. Unlike a tech business or more white collar oriented businesses, it's just not as big of a variable. So for me, I found them to be tough to differentiate, constant noise coming out of them, and a lot of variables outside of my control.
Yeah, I agree with everything you said. It's not a business without its challenges. I think the seasonality is really important, but I think you're just reiterating what I'm saying at the end anyways, which is they're not worth 18.5 times.
Exactly.
For all the reasons you just said. I totally agree. And scale doesn't help a lot of that. Scale might help you with some diversification across seasons, because if you're all over the US, somewhere you're going to have some hot weather, hopefully, or some extreme weather. But it's not like you can move labor that easily. It's not like if you have labor in Michigan idle, you can move it, to Florida overnight. And so I agree.
There is some economies of scale with procurement and fleet and training, but the biggest area of scale benefits is in branding. If you own your local market, which is hard to do in Dallas, but you can do it in Port Arthur, Texas, right? If you own your local domicile and you dwarf every other competitor in terms of billboards and number of vans on the street and where technicians want to work, that helps your pricing power. And I've seen that. I sit on the board also of one that is positioned like that in Alaska, and they have a very nice market position, small business, but very dominant in its local geography. That's an attractive feature to me on the residential side if you own your geography. Outside of that, and it's a chicken and egg. If you don't have it already, it's hard to get it. But if you have that already and you're entrenched in a geography, I think that's one feature that I can really appreciate.
I totally agree.
If you're well capitalized, can't you buy market share? Because it's all an online lead gen game at this point. I understand branding is part of it, but isn't it a decreasing part of it? And 80% of your leads are just somebody searching HVAC replacement near me, and you can just, if again with the appropriate amount of capital, blow everybody else out of the water.
You can. You just have to be good at converting it, is my perspective. I don't know, Nicholas, if you have a different one, but you could burn a lot of money on Google if you're not good at converting it. If something is wrong in your funnel.
Sure.
I think my perspective on it, and I know I'm not the interviewee here, Will, but is that one of the reasons M&A is so attractive in HVAC is because it's actually competitive in terms of a place to put your capital in terms of growth. For many, it's cheaper to grow through acquisitions than to grow through organic acquisition, so to speak. And this has only gotten worse with all the influx of capital.
Yeah.
PPC today it used to be a special trick. The sophisticated small players could do it in 2019. In 2026, PPC is honestly, you spend $600 to get a lead, and then you have to convert it, and it's hard. That can only be justified if it's a really long-term customer with a lot of systems and so forth. So the PPC game is largely commoditized at this point, and that's why there's even more pressure on M&A to be the growth driver, and that's continuing to push the multiples up. Or I agree with Eugene that the multiples have probably been pretty flat ever since cost of capital came up, but remarkably, they have stayed pretty flat since 2022.
They haven't come down, yeah.
That I think is true.
Yeah, and actually, an interesting thing for your readers or your listeners to search is go to ChatGPT and type in cost per click for HVAC in whatever city. And the one thing that's gone up, and the beneficiary of all of this has been Google and Meta. And all the marketing platforms, because the cost per click has gone one direction. The cost per conversion, which follows the cost per click, has gone the same direction. To Nick, to your point, marketing has definitely become more competitive in these markets as private equity has done what Will's suggested, which is, okay, we'll just pull the lever of more marketing. Well, there's only so many systems in the market anyways.
Well, and Eugene, that just reminds me, we're getting really in the weeds, but your point about, getting in early to a business where there's starting to be some consolidation activity. I do think that there's something to be said for finding industries where the PPC is still very immature, because there's a window of time, as there apparently was in HVAC 2016 to 19, where you could probably buy market share because the cost per clicks were still low enough that it was there for the taking, and it penciled.
Totally. Like every other early e-commerce entrepreneur will tell you, they should have been deeper. When meta leads were nothing versus today, right?
Exactly.
I do think you're right.
Yeah, exactly. Well, Eugene, we're way over. You are a lot of fun. We still have the third LinkedIn post. I saved this one may stand on its own, so I don't think we can give it 20 minutes, but I don't want to let you go without at least giving you a chance to talk about sub $3 million EBITDA is just a job.
Yeah. Okay. So I'll give a quick synopsis to what that post was about. Look, I take the perspective that you can't smash a bunch of $2 or $1 million EBITDA businesses together effectively, because you're effectively buying someone's job 3 times or 4 times every time you do it. Different than some of your listeners who might not be, independent sponsors that might be search funds that want to buy a $1 or $2 million EBITDA business and run it. That's different because they're underwriting the cost of their own time to run and grow that business. And I know a bunch of people that have done that and have been very successful with that. So, I think there's a distinguishing feature that I'm making between an independent sponsor or private equity firm buying a $1 million EBITDA business and a search fund trying to buy a $1 million EBITDA business. I think the underwriting that the search fund does is more accurate, where they're accounting for their effort, and the returns don't really come from the acquisition. They come from their effort layered on top of whatever this business was as a starting point, versus thinking that, hey, buying a $4 million EBITDA HVAC business, to go back to that example, is expensive, but I could get a couple of $500,000 EBITDA branches with 3 employees for way less. I'm going to smash those together. I'm going to call that a business. And what I've seen firsthand and through some friends that have tried this approach is you're not buying much. You have to add 1 employee and suddenly you have no EBITDA, or your EBITDA is basically, half of it is gone, and your multiple is now higher than it would have been if you would have bought a properly sized business. And, this holdco approach, everybody references Warren Buffett. I'm just going to buy these businesses and they're going to endure and cash flow. Warren Buffett has never bought a $1 million EBITDA business. ever, especially if you adjust for inflation. But even if I take it in nominal dollars, I bet you he never bought a $1 million EBITDA business. And so I think the problem is, trying to take what works at scale and do it in the micro M&A world, just doesn't work. So that's what that post was about. And surprisingly, it also got, a lot of engagement, more than I thought, because I thought I was saying something pretty obvious, but it still got a lot of engagement.
Eugene, we heard you say that you looked at kind of a search path and then I guess quickly dismissed it, or you said something like, that was an option, but I wasn't going to do that. Why not? Just because you don't want to be an operator full time?
I have been either fortunate or unfortunate to have started a few businesses in my life. And so I know what a really small business on a day-to-day looks like. I know what the 0 to 1 looks like. Let's put it this way. And when you're doing sort of a search fund, you're buying something, I don't know, 2, 3 of EBITDA. You're not at 0, but you're not far away from 0 sometimes. You know what I mean? And I didn't want to do that. I don't think that's where my skill set is best. And I don't think it requires a lot of managing of various types of people that I think I'm not good at managing. So I'll give you the best example. We own this laser hair removal business. My wife manages the day-to-day clinic operations. We have about 19 employees. She manages all of them. I interact very little with any direct employee. If I interacted with them, we would quickly have one employee because they would quit. And so I think it comes down to what you're good at. I think some folks that have really strong operational experience and not maybe deal experience are really well suited to do a search fund, because they'll do the search once, they'll do the deal once, and then they're really just leaning into the thing they're good at, which is operating a business. I don't think I'm terrible at it. I just don't think I'm the best at it. And so, as a result, we kind of said, look, we want to get involved only where we think we could add value. And I think the CEO at our generator business, if I got involved very deeply, would be very unsatisfied with my involvement. I think he very much enjoys the involvement that I have, which is, much higher level. So I just think it comes down to your relative skill set.
And Eugene, what are your superpowers? Your top 1 or 2 superpowers?
I don't know if I have any
other than talking on a podcast.
Yeah, apparently, and ranting on LinkedIn. Look, I think I enjoy sort of the creativity of, okay, we're going to buy this business, and these are the 3 things we're going to do to it. The reality is, there's a lot of work that has to happen to make the 3 things happen. I don't know if I enjoy the day in and day out actions of getting that thing done. And so there's some people that really enjoy taking a task, seeing it to the end, and getting it done. I have 10 ideas a day. I do like 0 of them per day myself. And the reality is, it's kind of like, what's the word I'm looking for? It's like shiny ball syndrome, I think they call it. Like I'm so
Object.
Yeah, thank you. Yeah. And so it's like, I want to think about 10 ideas. I want to beat up all of them with, my business partner, or in the laser hair removal case with my wife. I want to stick to the 1 or 2 that are really, really good. And then I want to just check in on how well they're doing as they're getting executed. And then I want to learn from that and reapply it. And whether I learned something in my HVAC business that I applied in my laser business almost every day, specifically on the PPC side. Both are incredibly marketing heavy businesses. In one business, we were spending $4 million of marketing, and in another business, we were spending $30,000 a month. So whatever, $360,000 a year. But the learnings were really, really interesting. I like doing that. You can't do that if you're stuck on the task that you assigned yourself 6 months ago that you're still seeing through. And so just, I guess I'm lucky to be in a position where I can choose what I work on, and I want to work on a various bunch of things, but I want to work on them at the start and at the end.
What a fun conversation. Eugene, you've got your first deal, which we talked about. It sounds like you might want to do a second or a third one here before you kind of leave the portfolio where it is until you have an exit. We hope that you'll let Minds Capital know when you have that second one under LOI. We invest equity into independent sponsor-led platforms. We love what you're doing so far. So keep us on the call list, please.
I will. I appreciate that. And I appreciate this fun conversation we had today.
Thanks for joining us on the Mind Capital podcast. Eugene Polevoy.
Thank you so much, guys.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.